All right, let's start. So we want to get through. So paper five, you should be in great shape on paper five. I know you haven't even thought about it yet because you're still doing 2, 3, and 4. As we said on 2, 3, and 4, a lot of students do 2 and 3, and then 4 can be a little late. 4 can be part of 4, 5, and 6. And I'm willing to meet with you if you need help on 4. Yes. So did y'all get the email or not?
Yeah.
Yes. Okay.
There's freaking dogs for meeting.
Are you already here? I felt bad. Some of them drove like an hour to get here, and then I was like, "Oh, I didn't get the email." I was like, "Oh, sorry." All right, let me get y'all for attendance then, since you're here, because I won't see you on Zoom then. Okay. All right, so once you get 3 out of the way, so I have a few people still needing data for 3. If that's the case, let's get that done as soon as possible. 3 is a paper you can get a pretty good draft in an hour and a half just by following the video, but you have to have good data. So, and some of y'all will have data where you're missing one number, and there's ways I can fix that for you, but you probably can't fix it. You probably have to send it to me. So like you're doing revenue per employee and you're missing one employee number, you can't just go look it up and find it and just plug it in on that spot. You have to plug it in the right place. And you can spend 7 hours figuring that out or send it to me and I'll fix it in 3 minutes. So it's somewhat your choice. So you say, hey, I was missing 2014 employees. It was actually 114,000. Can you fix that for me? And I'll fix it and send it back to you. All right. So, right. So what we're going to do, paper 5, we've talked about the risk-free rate. We've talked about the market risk premiums. So what we got to do now is talk on the beta. So on beta, there's 4 pieces to it. The first one is a discussion of what kind of firm do you have. Now, I was listening to a business breakdown today. It was pretty interesting. A firm I never heard of, but very interesting. It's a fuel card where they do fleet fuel cards, and it's the largest player in that business. Very interesting, and they do some strange stuff that seems unrelated, but they were talking about it. But they got into the discussion: is this a high beta or low beta company? And because 60% of the business is one thing, but 20 and 20 are other things, they talked about that interaction. And so is your firm cyclical or not? So Jose, that sounds like an obvious cyclical stock to me, right? It's tied to the housing, flooring. People aren't going to replace flooring if the economy is not strong. They're not going to be buying houses. It's also probably maybe a little bit impacted by interest rates, mortgage rates. And that's another, so it's not just the economy, it's any economic factor. So inflation, mortgage rates, the economy is the most important one. So now Visa, again, where I was just talking to Hoang about a Visa, they talked today about how a credit card high inflation can be good because they're getting paid a percentage of revenue. So if inflation's higher, revenue's higher, but then volumes are down because people can't buy as much. When prices are low, people are buying more, but they're getting less. So that interaction is almost self-hedging, kind of interesting. So, and it depends. This was a fuel card, so they're specifically looking at fuel prices, which is a little different than overall inflation. So if you're doing Visa, yeah, it's going to be number of transactions, which is probably heavily controlled by the economy. So Hoang could do an analysis where he brings in all of Visa's and MasterCard's transactions and see if there's any correlation between that and economic growth. You could certainly do that. Or you just subjectively say, obviously, there's a relationship between these two. Some of your other stocks, real estate, if you're commercial real estate, Allison, that's going to be very, very high beta kind of operation. If it's residential, it's going to be more tied probably to mortgage rates than the overall economy, but also tied to the economy. Those doing travel, transport tends to be transportation is almost the ultimate high beta because it's usually the early indicator that the economy's turning around. Usually when economies turn around, you start seeing shipping picking up. So it tends to be an early decliner and an early coming back kind of firm. So I would probably put a higher beta on a firm like that. Alex, I can't remember your company. PayPal. Yeah, PayPal is probably a lot like Visa, or it's going to be transaction based. There's probably some relationship with that. How about miss? And you're doing Florida. Okay, so yeah, high beta. And Lance, you're doing yeah, y'all, you and Selma, and then Lance, I can't remember.
MasterCard.
Yeah, so you and MasterCard. All right, so we've got everybody covered except for those on YouTube. So it is subjective, but I'll give you points if you at least try something. Let's say you try something. Let's say Hoang and Lance try to do transactions versus the economy, and nothing comes forward, and you can write about that. Just say, hey, I did analysis to see there was really the analysis was not conclusive, so it's hard to draw, but just I'll give you credit for at least trying. All right, so it's a little tough because economic numbers come out quarterly, and so you'd have to convert your data to quarter, and then quarter. The problem with quarter is the fourth quarter is going to be high because of holidays. So you're probably going to want to use annual data. The fortunate thing you have with Visa, MasterCard is there's probably a lot of annual data. So you probably can go back pretty far using annual data. So if you can go back 20 years and compare them, you got a couple of got one big recession in there, two if you can count COVID. But it's tough. It's hard because there's so much noise in these numbers. So the subjective works pretty well as well. We were talking about with Alejandro with Deere. With Deere, yeah, it's heavy industry, but it's also primarily to agriculture. You have to kind of play those two against each other. So here's a discussion. I've never tried Googling this, but you could try. Let's just try. It's Visa, a high beta stock, to see what comes up. Yeah, they'll give you the historical beta. We don't care about that. But some of these valuations you see online, they may have a discussion on beta that might be interesting, might be insightful. Who knows? So some of y'all, it's gonna be really obvious. A few of you, you're probably gonna have a little bit more of a discussion. So cyclical stocks are gonna be above one. Then the question is how much above one? Consumer discretionary by definition is high beta, probably in the 1.4 to 1.7 range. Real estate kind of depends if it's kind of build to suit. Manufacturing probably not as sensitive, say as office and residential. Durable goods are typically going to be pretty high. Financials are a little tricky, but you expect, especially banks, none of you are doing financials, but you expect banks to be harmed in a recession because their loan losses are going to be higher. Most productive metals are going to be very, very high. Steel, concrete, those are going to be high beta. Tech can go either way. Kind of depends. People are talking about tech becoming more of a staple. So people are going to make sure their phone's working no matter what, although they may be keeping their phones longer. But tech is kind of questionable. It depends on the kind of tech. Consumer goods, fast food. I typically put fast food somewhere around one. I don't make it particularly high or low. And we got a few Chipotle's in here. I'd probably put them pretty close to one. And the defensive staples, consumer staples are by definition. So Costco's not in here. So Geronimo, Costco would be probably a lower beta than even Walmart. Utilities, none of y'all are doing utilities, but low. Energy, I think all y'all gave up on energy. Energy is pretty tough. I tend to think of energy as slightly above one, and not, most people are going to buy gasoline no matter what, but if the economy is weak, they may not be driving as much. So, and I don't know if y'all heard the discussion. It was interesting with Tim Hendren last week. We may have talked about it in class, but is the movie theater high beta or low beta? He made an argument lower beta than you think because it's the substitute for vacations. Those are kind of arguments that are really impressive in a paper like that. Even if I disagree with you, the fact that you're thinking creatively like that. Pharma tends to be lower beta. It kind of depends with pharma because a lot of people pay for their healthcare through their employment. So if people are losing their jobs, they may be cutting back on healthcare. If pharma's for retirees, then that's Medicare, so it's pretty inflation protected. And healthcare in general tends to be lower beta. But so it's not just if it's cyclical or defensive, but how much. So you got to get the degree of one in there. All right, so a few paragraphs. Anything you add that's interesting is good. One thing that does not work is trying to correlate your firm's revenues to the economy because accounting numbers do not work in regressions. You can try it, but it's just not going to work. So, all right. Then we're going to talk about leverage. Operating leverage, again, is a subjective discussion. Does this firm have a lot of high fixed costs? It's really two pieces here. How elastic is the demand and how much are their fixed costs? If a firm has a very elastic demand, their customers are very sensitive to price, that's going to kick your beta up. If a firm is insensitive, like tobacco, tobacco's insensitive. That's why governments love taxing tobacco. You can just tax it to death and people keep buying tobacco because you get big tax. They say they're taxing tobacco to get people to smoke less, but they love it because it's a wonderful tax source because it's very inelastic demand. So elastic demand is going to have an impact. And then fixed costs. Where do your fixed costs come from? So you mainly salaried employees or hourly employees? Heavy union or not? So Jose, I would think Flor Decor and Juan Carlos, I would guess they may be like commission based, but I bet they're pretty high skilled employees for retail. That you walk in there, they know floors and they're, if they lost those employees, they'd hate it much more than McDonald's losing an employee. So they're probably their turnover is lower. So even if they're hourly, they may be stickier because they probably don't want to lose those workers to Home Depot or whatever. So they're probably going to have a little bit higher price and fixed costs than a McDonald's that say, hey, let's just cut your hours. So salaried are sticky hourly employees. Heavy union tends to be higher fixed costs because there's a lot of restrictions on what they can do. Heavy capital equipment, because they're going to have a lot of depreciation, that's a fixed cost. And I always say that's not economic, but it does still make them look much more volatile when the numbers come out. So a lot of property, plant, and equipment tends to make them very volatile. And then if you have like Nike, Adidas, you have a really strong marketing budget that you have to spend. That's going to be a fixed cost. You got to keep going. Pharma with high research and development, that's going to be a fixed cost that you got to keep spending. So, and then you get firms like a Visa or MasterCard. So Visa's out there on business breakdown, isn't it? So I think they talk some about they don't really have that many employees. The employees they have are mainly IT because this is really a data company. So it's interesting. The one today I was listening on business breakdown talk about just how amazingly high their margins are. Gross margins and net margins, very, very profitable businesses. So you can certainly go back historically, and we're going to talk about it and look how volatile their margins are. So we'll talk about that. That to me gives you a good indication, but it's a little bit mixed. It's both the elasticity of demand and their fixed costs. So it's kind of a combination of both. So subjective discussion, and I'll show you some quantitative you can do. Below average, inelastic demand, very flexible workforce, commission pay kind of thing. I haven't looked at Uber and Lyft, but my guess is, that's going to be very flexible workforce, although they have been doing some things to kind of beg their drivers to come back, which are fixed costs. So, kind of depends on where they are in the cycle. They don't have a lot of huge employee benefits, so that gives them a break. I think with Costco, I might talk a little bit about the fact that they pay their workers more, so their turnover is lower, and that probably gives them some advantage in this area. All right, so how can you figure out how much operating leverage firm has? So the first one, I don't think works, but that's regressing gross margin, net margins to revenue, just kind of see what that slope is. That doesn't really tell you much because, first of all, you don't have enough data. You can't use quarterly data because of seasonality. Annual data may only give you 10, 15 years, and there's a lot of noise in accounting. So I haven't gotten that to ever work. But even if you do it, you get the slope. It doesn't mean anything to you unless you compare it to the slope of a bunch of other companies. So you say your slope is 0.6, is like, was that high or low? So I've had a few students try that. I just don't think it's too helpful. So we're going to do this. I'm going to give you all the numbers. Those that have had me before, y'all remember this. So if you just calculate the standard deviation of the gross and net margins of your company, that's going to tell you. Now, what you can do to really add some value here is to do that also with some of your competitors. So Visa, MasterCard, and PayPal, I would do those three companies. I would do Discover, I would do the others, just to say, well, we'll do that right now. So you've got this file. I can't remember if I put it on Canvas yet or not, but I will. So let me do Visa. So what I recommend that you do is
The screen is off.
oh, sorry. Wow, what are you going to tell me? All right. Are y'all watching me on Zoom? All right, so like that get warmed up. How many of y'all? Okay, so Alex, you've never seen this before. Selma, have you had that class before? I can't remember. Using the standard deviation of margin. Have y'all seen that? You've seen it. Alex, I don't know if you've had that class.
Is it in your investment class?
Yeah.
Yeah.
Oh, you were in my investment class? Well, I don't remember that. When was that? Was it during COVID or something? When?
It was last semester.
Oh my word, I'm gonna have to go look you up. Sorry, you're in the back and I'm not wearing my glasses, so I might.
You're good. Start right here too.
Really? Oh man, sorry about that. Okay, so you have seen it before. Wow, I usually don't forget faces, but I gotta get my eyes checked. All right, so the first thing you do when you get this file is go to the companies and find your company. So you're on that line because there's 3,000 companies in here. And then just in this cell, just do equal and get your ticker for your company. And so they don't have a gross margin, so you can't use that, but that's fine. I think they do have a gross margin, but Bloomberg doesn't bring it in on some companies. So no gross margin, but they do have a net margin. Their net margin is quite volatile. So why is that? So something you could do if you want to do extra research, it's not necessarily regress it, but mainly look at an income statement and try to figure out which line on the income statement is causing that to be so volatile. And you could certainly use a common income statement where you do everything as percentage of revenue and see if there's anything that's causing that to fluctuate around. But that's a very volatile net margin. My guess is probably most of their costs are fixed costs. They probably don't have a lot of variable costs. Their revenues are very sensitive to inflation, to the economy because of transactions. So that may make sense, but let's see if it really makes sense. So let's bring in MasterCard. It is high, not as high as Visa's, but it's above average. So there's two in a row. Now let's try PayPal. Very, very low. So that's it. Why is PayPal's margin so stable? Very, very stable. So that's something, Alex, you have to try to figure out. Why is that? I mean, that's interesting, isn't it? We can look at Discover. Discover is a little bit different animal, and we may get the wrong Discover if I do this. There's a couple of Discovers out there. Here it is. I think Discover actually takes some credit risk. It's more of a bank than these others. Oh, they don't even show it, so it doesn't even show up. So what you could do if you bring those three in is you could create like a bar chart or something, compare them, and then discuss. It's really unusual. Can you think of a reason PayPal would be so stable in their earnings?
They do apply this stuff more than just like the big payments.
Yeah, a lot of just transferring cash.
Yeah, the biggest thing is also transaction volume, for sure.
But why would their transaction volume not be related to MasterCard and Visas? I don't really shop with my PayPal. I do collections for my charity through PayPal. So, you have to just kind of think through it. If you can come up with a reason that makes sense, that's what you're looking for. So floor and design and the floor and whatever. How many floor and decor? Very, very stable margins. That's interesting. So that somewhat implies I don't have a lot of high fixed costs. So that's surprising to me, but very, very stable margins. And you can see it when you look at them. Part of their problem might be they don't have as many years. Their gross margins pretty stable. You saw that in paper 4, right? Paper 3, you're gonna talk about that being really stable. Their net margin 7, 8, 8, 6, 5, 7. That's pretty stable. That's impressive. So you look at that, very, very stable, and then you go say, well, let me look at Home Depot and see if it's similar. Home Depot's a somewhat different business, but at least it's tied to the housing market to some extent. Stable, not as stable. So you get extra points if you bring in some competitors just to see if it's consistent. So Visa, MasterCard, pretty consistent, very volatile. Retail, you often will see retail is somewhat stable. Just the nature, because retail is so focused on margins. That's what they do. They manage the margins. So it's just the nature of the business. So the way this works is, just make sure we understand this. This is not their gross margin. This is the standard deviation of their net and gross margin. So this is their standard deviation. This is the standard deviation of the stock market. It's net margin. This is the standard deviation of Home Depot. So they rank in the top 15% of the most stable. So they're a pretty stable firm. But as you'd expect, so Jose and Juan Carlos, I would probably say, as you would expect for retail, with their focus on margins, their margins are fairly stable. But then how much more stable are they versus Lowe's and Home Depot? So if they're much more stable than Home Depot and Lowe's, you might argue for a lower beta for them. All right. It's the same thing with the history. When you do the history, you can map the history of all these stocks on the same graph and say that's consistent with my historical betas. So there's things you can do in this paper that are pretty simple to do. They take an extra, 5-10 minutes and adds a lot of power to your paper. So my argument is, if gross margins are really volatile, that implies really elastic demand. If net margins are volatile, that implies elastic demand and a lot of fixed costs. If they're inconsistent with each other, you gotta kind of think about the business. Make sure this isn't the only thing you do, though. So make sure you have a subjective discussion about fixed costs for your firm. Think about it, what kind of employees they have, what kind of advertising they do, those type of things. You might even just bring up the annual report, which has a more detailed income statement, and just look across over time and just see, or bring in the entire financials in Capital IQ. That's easy to do. And if you don't have that Capital IQ on your PC, you can bring in all the financials, find an income statement, and just look across, see if there's any line that just kind of doesn't fudge at all. It's just always there. What's moving around, what's causing the volatility. Okay, what do y'all think? Operating leverage, so we look at a couple other companies. Let's try a couple others. So you're doing UPS or FedEx, Claudia?
UBS.
Okay. Someone's doing FedEx there, right? I think. You can just look at it. That's pretty volatile, gross margin. Now, what would you think would drive their gross margin? I would think fuel costs, but it is a unionized workforce, right? Their net margin, well, their net margin was stable there for a while, then they had a really horrible year. They're pretty volatile. Let's see if it comes up in the numbers. They're much more volatile on the gross margin than you're on the net margin. Why that is, it's hard to say, but I would think the gross margin is really being driven by fuel prices, which are pretty volatile. But they're pretty stable on the net margin. How they're able to accomplish that is pretty interesting. What are they doing to offset the fuel costs in their other lines? Maybe they're hedging it and that's going through another line, who knows? And then you compare that to FedEx. Very different. Those two firms are very, very different. Now, it used to be the big difference between FedEx and UPS was capital leases. But I don't think that's true anymore with the new accounting. But it used to be FedEx was heavy on capital leases, on operating leases, and UPS wasn't. But I think the accounting changed, so that's not the case. So they're both stable on net margin. This might get back to what I was talking about cost of goods sold. It may be how they classify their costs too. I'm assuming they both have fuel costs in part of cost of goods sold. That just makes obvious sense. But why one's different than the other? Maybe FedEx hedges and UPS doesn't. Who knows what's going on there? So it just, you have sentences like, I find it interesting that, and then maybe this is because, if you can come with an answer, or I'm not real sure what would cause this, but it does suggest UPS would have a higher beta than FedEx. Now, is FedEx less unionized than UPS or not? Do you know on that one? Is UPS more unionized than FedEx, or are they about the same?
No, they're pretty much similar, and it's not much difference.
Yeah, you wouldn't think it'd be too radically. So there are some differences in these two firms. Figuring out what they are that impacts the volatility of their earnings. That can be tough to do. But FedEx, you can almost argue a slightly lower beta just based on these numbers. Okay. So let's talk about financial leverage. Financial leverage is a little bit easier. This is something you may go back to paper 3 and just look at what their financial leverage has been over time. Has it been coming down or is it going up? Because that's important when you're looking at historical beta. Remember, historical beta is influenced by the amount of debt. So if a firm had high debt and now it's lower, then the historical numbers can be exaggerated. So you'd have to take that into consideration. On the financial leverage, you can just bring that in. So you look at, this is FedEx, heavy debt. But on debt especially, you want to bring in some competitors because debt is very industry specific. So here, look at that. They're almost identical, right? 72%, 79%. Their levels of debt are about the same. You would expect that because they got a lot of trucks, they got a lot of assets that they can use as collateral, so they have heavy debt. So the fact that their debt's higher than average might not push their beta up that much because these firms tend to have higher than average debt. So that's fine. Some firms, let me show you. So Kroger is a good example. Grocery stores don't usually have massive amounts of debt. Kroger's does. Kroger's a low beta company with a lot of debts. So you're gonna have to debate how far up do we push that. If you want to use the formula, you can. You can see the formula out there. You just put leverage beta, and the formula will come up somewhere out there. So there's levered beta. So if you want to say how much, if my debt was 50%, so you might bring in a few companies, say, you know, the typical, or you go back to paper 3, the typical debt for this industry is 60%, but my firm's 80%. Have y'all seen this formula before? I think Catapacum used it in his class. It's a real simple formula. You could just adjust the formula, just assume a 40% tax rate, adjust the formula for a debt to equity of 60% versus 80%, and just see how much it changes that beta. You could put that in your paper. That'd be impressive, and it would be really simple to do. So maybe look at 3 competitors. So Jose and Juan Carlos, maybe look at Home Depot, Lowe's in your firm. Say, wow, my firm's debt's a lot lower than those two. How you could use this formula to kind of back in how much am I going to bring my beta down for that? All right. Now, I would not let debt push your beta radically. So if you've got a cyclical company, I wouldn't let the low debt put it below 1. If you got a defensive company, I wouldn't let high debt push it above 1. I would just go closer to 1. All right. Don't go the other direction. But this is a famous formula, and it's pretty easy formula. Just use a 40% tax rate. And so what I give you here is just the actual debt to equity relative to the stock market. So let's try for the core 1068. Pretty high debt, 70%. That seems pretty high for a retailer, but let's see how that looks versus Home Depot. Well, 40. Oh, wow. Oh, okay. So here's where you have some issues. Home Depot has very little equity because they've been buying so much of their stock back. So you almost have to throw them out. All right. So let's see if Lowe's will work. They don't really have high debt. They just don't have much equity left. 1605. Oh. Yeah. So Home Depot and Lowe's are 2 of those companies buying their stock back. So sorry, you can't compare. But other specialty retail, you could find some other specialty retail and use them to give some sense of what's going on with the industry. So
Their data will be low as well because they have segments on areas where they do well with that.
Yeah, they're more diversified. Floor and decor is so floor and decor is probably new construction and remodeling, and those are both high beta and mortgage rates. You know, even redecorating, most people borrow money to do that, so they're really sensitive to mortgage rates. And it can be a little tricky because you got floor and decor is growing fast, so it almost seems to be defying gravity. But once it gets to normal size, it's going to start looking more like a cyclical stock. So their history might be a little bit unreliable because there's just a small company growing fast, and so it kind of defies gravity. Let's try. We did UPS and FedEx, very similar. Let's try Chipotle. So Chipotle's gonna be another problem because there's so many restaurants with negative net worth. So you want to compare it to Starbucks and McDonald's, and they're all going to give you NAs. Very frustrating, unfortunately. So that's just the nature of this industry. And I can never spell Chipotle. Oh, I got it. I put the L in the wrong place every time. 604. Pretty high debt. But I can't compare them to anybody. I can't think of anybody I can compare them to. Maybe Sonic. There, Sonic's not in there, not Sonic Automotive. All right, so this is another one. You can either do multiple companies or go back to your paper 3 and just see relative where are they on debt. The issue you got paper 3 is debt to EBITDA. This is debt to equity. I use debt to equity because that's what's in that formula. But you can somewhat kind of ballpark it just to see the nature of it. So a good thing to do here, get the actual, here's that formula I just told you about. There's the actual formula. That might include other fixed charges. So for Chipotle, they include the capital leases. So capital leases can be in there. I think you do want to include capital leases as part of that debt. Because that is definitely a fixed cost that's going to look a lot like debt. All right, so most people get pretty close to full credit on the financial leverage because it's pretty straightforward. Now, what if your company is one of those? And I don't think any of you do because I kept those out if they have negative net worth. So I think all of you avoided negative net worth. But if you have a firm like that, what do? You'll just have to look at paper 3 and just see how much debt they have. Does it seem high? Whatever. You have to substitute debt to EBITDA for debt to equity. I didn't bring in debt to EBITDA because the spreadsheet's getting too massive. I don't necessarily think you should put this chart in your paper. You can certainly talk the numbers. Where are they versus the industry? If they were 267, they're in the top 10% of the entire stock market. So there's some things, but I mean, some students do actually put this chart in there, but make sure it's, that you can see the company's name.
Is that spreadsheet going to be made available on?
It'd be on
Blackboard?
Canvas under files or papers in the same place the Walmart file was. I thought I put it out there, but I may not have yet. I can't remember. I was going to update it, but then I thought the last time I've updated it was through 2022. And if I do 2023, there's just too many NAs. So it was pretty much updated. So I just updated it for the current Russell 3000. All of your firms should be in there. I can't imagine one of them would not be. All right, and then the last thing you want to do is the historical beta. So some of y'all have done this before in my classes, so it's fairly straightforward to do. So let me just walk through that. So you go to Yahoo Finance. And so let's do UPS and FedEx, right? So we got two companies that are very similar. So you find UPS, you go to historical data, you want it monthly, and you want all the history you can get. So you want max on the dates, you want monthly, you hit apply, and then you download it. Which of these columns do we want? Anybody remember? Adjusted, right? So those dividends don't impact our beta. That's one area where might cause a slight difference with you versus what Yahoo shows. I'm not sure Yahoo uses adjusted. So that's UPS. Let's bring in FedEx. Now, if you enter it right here, it will update this. You can just hit, it's just max and apply, and it should already be ready to go, and then download it. For some reason, it downloads earliest the latest. Now you can see here, it starts back in 1985. I don't have 1985. I only have 12/199. So I'm going to go find 12/199. Bring that in. And then just make sure. Oh, 12,199. Sorry, I messed that up. 12,199. There it is. All right, so it's lined up. So I've got FedEx. And what else do I need?
Yeah.
Well, we could do DHL if we can find it. It may not have enough data. Are they a US company? Yeah, it's private, so we can't do that. Well, we'll stick with these two. And then I want to do the S&P 500. So for the S&P 500, you actually want to do SPX. You don't want to do the one that's up there. The one that they show up here, the GP whatever, they won't let you download it. But with the SPX, you can download it. So we'll do historical, monthly. Let's say we want it. Let's do 11/31/1999. Oh, 11/30. Apply and download. Here, it doesn't matter if you use adjusted close or close because you're going to be the same. So it works. So let me bring that in just to make sure. They line up. That's good. So if I were you, I would bring in the competitors because this can make a really cool graph. Now, one of my students built an online version of this where you could bring in multiple competitors, but he did it in Python and now he's converting it to something. And so his website doesn't work anymore. And I have no leverage on him because he did it all for free. So I can't really get him to fix it. So he sent me the Python program and I'm not a very good Python programmer. So I couldn't do much with it. I've been tempted to because I mean I can read Python language and could probably adjust it pretty well. But all right, so we got these companies. What you got to do next is the holding period return. So the holding period is just because we're using adjusted close, we don't have to worry about dividends. Just this ending divided by beginning, close parentheses minus 1. The ending for the current month divided by the previous month, divide those, and that whole thing minus 1. Now this shows you their return for that month. You just need that for all three. I'm going to take out October because it's only October 17th. And so now we're going to do rolling betas for UPS and FedEx. I do 5 years monthly. How many months in 5 years? 60. So let me go down and find 60. There's 60 right there. All right, so you may remember the formula for slope, for beta. Slope, yeah, so equals slope. And what do you do first, your company or the market? Your company. So we do our company and the market. We want to lock in the markets column. There's FedEx. Copy that down. We'll graph it. Look very, very similar, don't they? Just extremely similar, and that's what you're hoping for. So it gives you some now. FedEx is a little bit higher than UPS. There may be a reason for that, which is kind of contradicts what we saw with the volatility of net worth, but they are very, very similar. You just need to add in the dates. Make sure you start your dates where your data starts. I have students start the dates at the very beginning and everything's all messed up. You have to have the same dates. So there's UPS, FedEx, They just say rolling, beta, 5 years, monthly. And just like that, I mean, just doesn't take that much time at all. You want to change your axis. So you only want years. And why does it stop at 2018? I did something wrong here. Should go through 287. What did I do wrong? 287. Oh, it didn't do that right. Y'all see me mess that up? Did I mess that up on purpose to see if you are paying attention? Okay, so it should start on line 62. I don't know how I got line 3. Well, I must have been talking and clicking at the same time. So, and where did the graph go?
It's not the, this stuff.
There we go, 2023. And then try to get rid of extra white space here. We know 0.5 is not going to be right anyway, so that doesn't look too good, but you might actually even start it from here. So it's interesting. UPS has been below 1 for quite some time. You definitely want to change your axis so that 1 is on the graph. And I can get 1 on the graph. So that's too many lines. So you have to work with it a little bit to get what you want. But that's an impressive chart. You got 2 there. Some of y'all can do 2 or 3 or 4 firms. So MasterCard and Visa, the same kind of thing with PayPal, MasterCard. That'd be a really interesting chart. MasterCard, Visa, and PayPal all in one chart. That's when you'd really see if MasterCard and Visa are different entities than PayPal. It would look a lot different. With you, it's probably enough because that's the bulk of your competitors. I mean, those 2 together are probably, if you don't count Amazon, you know, they're probably the bulk of the business, probably 60, 70, 80%. So yeah. Yeah, if I were doing Exxon, I'd probably do Exxon, Chevron, British Petroleum. The problem with you get non-US stocks is you're going to get some currency noise that's going to mess things up. That's going to mess up the beta quite a bit. But yeah, Exxon and Chevron might be enough, the 2 biggest players, Valero and, you know, anybody that's a Marathon, that kind of thing. So if you can find 2, and yeah, I'm kind of interested, you know, see Floor and the core versus Home Depot and Lowe's, I think is going to be really, really interesting as well. You're really trying to see if there's one of these firms that's radically different from the other. So you put a chart in there. This doesn't become your beta. This is just more information. You can see how unstable it is. UPS is consistently below FedEx though. So that to me is really, really interesting. So that gives you a strong argument. And you might actually even start it in 2009, just the last 14 years. Since their debt is so similar, why would these 2 be so different? So there's something going on with these 2 businesses. I don't know if the business breakdown did a big discussion between UPS versus FedEx, how they differ. I know they talked a lot about Amazon and that, and you know, so you know that's kind of what you're trying to figure out is why is UPS so consistently a lower systematic risk company? And that's what you're looking for with beta is the sensitivity to the overall economy or to those type of macro factors. So clean this up, put it into your paper, especially get the axis looking good. I think I could probably fix this by starting at 0.4, going 0.2. There's my 1, so that looks a little bit better. And it looks like something happened 2006 through 2010. So that includes the financial crisis. One thing to watch out for on the years, you see how 2009 is in there twice. So you probably want to change your number of months to 12 instead of 10, just so you don't have a year repeat. And then you can get 20. And this is what really irks me. They need to set up something where you can tell it, make sure the last number is the last thing. You know, I want to have 2023 in the end, and they just don't do that. It's so irritating. Right. So we have videos that show you how to do this as well. So it gives you some great history. So now what you did in your other classes generally was you did that, and then you put the trend line on. I don't like this at all. If you do it on your paper, that's fine, but I don't like that at all because it just gives you one beta. And you can look at those two firms. You're getting a lot of information by looking how it goes over time. You saw both of their betas jumped up after the 2008 crisis. Once 2008 was in there, it jumped it up. So you had a really good test case there. But that doesn't, the slope of this is their beta, but that just doesn't tell me much. We don't know which dots the most current ones, which ones are the latest ones. So yeah, it's just not valuable to me. Right. So cyclical defensive, that's a discussion, maybe some analysis, but probably more discussion. And then leverage, I'm going to give you all the table for that. And then the rolling beta. Paper 5 is not that difficult to get out of. So most of y'all have done it in my previous classes, so that's good. And can you plagiarize that paper? Yeah, if you want to, you can plagiarize that paper. So you can copy your own words up through beta. I don't think none of you are doing the company you did in that class. I don't think so. It's not going to do much. Plus, things have changed anyway. All right, and then you put it all together. And so, what are you going to do? So you need to summarize your beta. I would say with a table. Let me find one. I'm pretty sure I can trust Bond to have done this. So I'm going to use Bond's paper. Oh, he didn't do it. And look what he did here. He put the companies in there on the net margin standard deviation. That's not a bad approach at all. He did put these tables in here, you know, so he did it kind of both ways. I mean, you can, I'm not a big fan of these tables because they're not normal. Yeah, so he didn't do what I was thinking he was going to do. He has a beta summary. Oh, here it is. He did do it. Okay, so look here. You want something at the end to justify what your final beta is. Betas, B-E-T-A-S, multiple betas are. So you want to have a base case, a best case, and a worst case. Your base case can be in the middle. Your best case is going to be the lowest. Your worst case, the highest. All right. So revenue sensitive defensive company implies that beta, low operating leverage from hourly workers and flexible. He did a really good job here. Historical financial leverage was immaterial for beta. History going back to 05, the beta has been 0.69. And so you need something like this table to get you off the table, get you off the discussion. Where I really count off points are students that do the first 3 and then their beta is entirely based on the history chart. Like that happens a lot. They just take the median off the history chart and they're done. It's like, well, you didn't need number 1, number 2, and number 3. You wasted your time. So make sure they're all in there. They're all consistent. Right. So that work. And then you might have a table with base, best, worst. And then you put that aside and you do paper 6. And when you do paper 6, you're going to say, oh my word, these discount rates aren't going to work. So then you're going to go back and adjust paper 5, or you get all the number crunching for 5 and 6 done before you start writing, and make sure what you do in paper 5 works for paper 6. They don't you get ridiculous valuations. So that might even be better. So remember, if your discount rate's lower than your growth rate, you've got a problem. So you're going to have to somehow work through that. Right, so there's paper 5. Paper 5 is probably the best one for looking at student examples because they're all going to look very, very, very similar, especially the later ones. And Bond followed my formats very, very closely, so he's a good one. I mean, he's a very good writer, and he followed the most, kind of just stuck right with the templates on these papers. If he has, it's got a typo there, so I caught that. So how many scenarios should you do? So I would not do scenarios on the risk-free rate, especially right now. I wouldn't do scenarios on the market risk premium. I would stick just to your growth rate and your beta. And the reason I don't do scenarios on those others is they apply equally to all companies. So you're trying to figure out if your firm is relatively over or underpriced. You're not just trying to figure out if it's overpriced, underpriced by itself. It's relative to other stocks. And so there's really no reason to adjust factors that affect all companies equally. So don't do scenarios on that. You're going to do scenarios on beta, do scenarios on growth. See, he even puts my name in his papers, so that always makes me feel good. Unless you say my idiot professor, that might not work as well. But questions on paper 5, or y'all just too focused on 2, 3, and 4 to even think about 5? But y'all feel more comfortable with 5, don't you? Because you've done this before, so it's gonna be all right. Valuation. So paper 6 is really all about growth rates. So that's where you're going to spend your time on growth rates. Unfortunately, you've already done some of that in paper 4. So you can't just ignore paper 4. You can't have high growth rates in your forecast and then have low growth rates in your valuation. So let me just highlight what we're going to do in paper 6. So you're going to justify the base, best, and worst growth rate. Justify base, best, and worst. Short-term growth. H. And then you're going to use 4 valuation models. I'm going to say 3 or 4. I'll show you what we mean here. So you need a dividend discount model, an H model, capitalized earnings model. So 2 of 3 here. And then 1 other model. And here I'm going to encourage you to get creative. So you're supposed to be using the traditional investment banking model. I'll show it to you. I'm not a big fan of it, but I'll show it to you. But what I actually recommend is still one from Capital IQ. So if you did the Capital IQ and you brought in all of those templates that they have, there are valuation models in there. I want you to steal one and use it for your firm. Right? It'll probably be real similar to what the investment banking is anyway. So I'll start experimenting. I was looking at I was really impressed. Cap IQ is really impressing me. Their templates are really quite phenomenal. I'll start experimenting with some of the valuation ones, and if any of them stand out to me, I'll let you know that I'm really noticing. Or if you find one you really like, it doesn't have to be Cap IQ. It can be Bloomberg. Bloomberg has some as well. If you do go to Bloomberg, they have Excel models that you can actually tap into on the Bloomberg machine. So those can work as well. So your goal here is the investment banking format. That's really what you're looking for. Okay. And then the last thing we're trying to do, it's actually too early here. So I'm gonna leave it out of this one, but ultimately what we're trying to do with papers 6 and 7 is get to football chart. So how many of y'all done a football chart? So that's not a good one. I'm getting too many football charts. So here's one. Have y'all seen this before? That look familiar at all? What you're trying to do with the football chart is you're gonna have three to four valuations in paper 6, and you have another valuation in paper 7. You may even have 2 or 3 valuations in paper 7. You want to list all of them with their ranges, and you want to compare that to the current price. And what you're trying to do is see, where does your stock current price line up with your models? Is it on the right-hand side or on the left-hand side? Okay. So if you're doing Costco, I haven't seen Hieronymo's assumptions yet. I'm guessing he's going to be far to the right-hand side. The current stock is way over here. That's what I'm going to guess. My executive MBA students all just valued Costco, and they're like, is it okay that all my valuations are lower than the current stock price? And yeah, Costco is an expensive stock right now. So this is called the football chart. I'll show you a video how to create it. It's pretty easy to create. You can kind of guess how to do it anyway. You're essentially, obviously you're doing a bar chart, but there are numbers here. It's a stacked bar, but this part of the bar, you're just disappearing. You're making the color white, you're making the lines white. So I'll show you how to do that. Why do you want to do this? Because football charts become really, really popular. So you want one in your paper. So I'm trying to force one in there so that you have a good football chart in your paper. Also, the CFA Research Challenge, everybody's using football charts in that thing. It's just become really common. So you want to make sure you do one so you get it in your paper. This is not the best one here. I don't know what to call it other than football chart. Maybe it's stock valuation chart. You try bar chart. Yeah, you see it. This is a more common one, but you're seeing a few more of them. I don't know what some of these other ones are. It's always going to go left, right. It's not going to be up and down. It's rare you see them like that. This is one I've seen before, so we've used this one example. This is really, really fun. So the dotted line is the current stock price or your target price. I like it when it's this current stock price. You can have 2 lines. One could be the current stock price and one is your target price. But I prefer to have the current stock price in there. So we're trying to build that. So that's the ultimate goal. But I used to require that as part of paper 6, but I'm actually going to delay this to end of paper 7. Because paper 7 is going to give you some more evaluations. So we just want to bring them all together. All right, so you see where we're going. Questions on any of that? Now, this weekend's a great weekend. I got one paper to grade, but it's an exam, but it's not, I'm already almost a fourth of the way through grading it. That was just today because we had a bomb scare, so I was grading papers. So if you want to set up a Zoom for papers 2, 3, or whatever, paper 4, if you want to set up time next week. So the next 5, 6 days are pretty good for me for meeting with people. I can come in for a Monday if you want to work on paper 4. If you want to Zoom paper 2 or 3, if you need data for paper 3, get that to me as quickly as possible, right? Is anyone to the point and needing to meet with me? I've seen some pretty good paper 2s already, so some students are pretty far along on that. So, all right, so email me. I'm doing so many Zooms right now. It's like I'm just zoomed out, but I'll give you all the time you need. All right, well, let's stop a little early since it's a bomb day. Paper 6, the bulk of the work is on the growth rates. You've already got your discount rate in paper 5, and that's pretty straightforward. You're going to use a model where you're going to pull a number like dividends per share or free cash flow per share. You're going to use that, the value of your firm. So it really just comes down to the only thing you have left is growth rates. So the question is, how do you get good growth rates? So probably half the paper is going to be on growth rates. And a normal way we think about growth rates is there's 2 of them. There's a terminal growth rate, and then there's a shorter term growth rate. The terminal growth rate is your growth rate once the firm's finished its major growth spurt. So once you've added so many stores like a Walmart, you just can't add any more. It's hard to say that with a Meta or an Alphabet, but at some point, Google and Alphabet, or Alphabet and Meta and Microsoft, they're Apple, they just can't grow any. They're just so massive, they just can't grow anymore. So at that point, how fast can you grow? So your terminal growth rate is probably going to be related to U.S. economy. I should put an extra comment here. So you have a couple ways you can do it. It could be nominal GDP. And where did you do that? You did that in paper 5, right? The implied approach, you use nominal GDP to get what a stock could be expected to grow. So you already have that. But I actually think a more important or applicable number is, let's think about a Walmart. Once Walmart has put all the stores in place that it can do, what can it grow? So for me, a Walmart is ultimately going to be population growth plus inflation. Or you might even commingle them. Instead of adding them together, you might do 1 plus growth times 1 plus inflation. You know, they kind of interact. There's that interaction factor. Remember, GDP growth is productivity plus labor plus inflation. So it's a little theoretical. Should Walmart grow with productivity? The fact that technology is going to improve, they're going to get more efficient, so they're going to become more profitable just because technology. So you could go either direction, but a firm like Walmart, you know, you have to kind of think, what productivity can a retailer have going forward? But either approach is fine with me. We also know that you can run ranges. So population growth plus inflation, population growth is essentially negative right now throughout the world, right? We're not having, none of the people are having babies. So you're almost down to inflation here, which means labor growth is eventually going to get down to 0 as well. If we're not adding more people, there's no reason for labor to grow. It's just going to be stagnant. So the question is then, what that range makes sense to be. So could this range get as low as 2%? If you just think 0 population growth plus inflation, could you have a 2 to 6% range? I wouldn't go below 2. I wouldn't go above 6. You might say, yeah, but Alphabet can grow fast, but it's not going to grow fast once it becomes a $3 trillion company. It's just, you just can't grow that fast. Your customers are people being born, and inflation. Once Netflix has every single human on the planet on its system, its growth is pretty limited. There's not much more you can do. Unless aliens, we find some people on Mars or something. So that terminal growth is going to be a low number. It's going to be in this general range. So we've already done the GDP growth, so you can just pull that number from paper 5. In fact, I would just say as discussed. Don't say paper 5 because that doesn't make sense for your research report. All right. So as discussed under the discount rate or discussed back on page whatever, I think our economy can grow in the 4 to 6% range. Therefore, my terminal growth of this company is the 4 to 6%. I mean, it's real simple. Okay, so you've got that number. You might actually use the 4 to 6% in your analysis when you're doing this. One thing to remember is the cap on terminal growth equals KE. Your terminal growth cannot be higher than your discount rate. That may be why you can't use the 6%. If your discount rate is 5.4%, you can't use a 6% growth rate. And you also have to be careful if your discount rate is 5.5%, you can't use the terminal growth of 5.45% because you're going to get a valuation of like $80,000. So minus something. So you can't. So as your growth rate approaches your discount rate, your valuation doesn't go up linearly, it goes up exponentially. It just kind of shoots up, and at some point you're approaching infinity. All right. So if your KE is 6%, your terminal growth is probably not going to be any higher than 5.5%. You're probably stuck with something in the 5% range. So that 6% may not be possible. Your discount rate is low. You are now seeing why I said to add in the stock buybacks in paper 5 to get you a little bit higher discount rate so you can use a little bit higher growth rate. All right. So then I'm trying to save you that issue. So that adds an extra 1.5%. So even Walmart or Costco is probably going to be at least 6%, maybe a little bit higher. So yeah, like those doing Costco, so like Geronimo, yeah, you're going to have that issue of your discount rate getting painfully close to your growth rate. All right, what about the near-term growth? All right, so here's one thing you can do. If you have your file for paper 3, I have this for Walmart, and I've range valued it, so they're data. So I'm trying to find. So line 35 is earnings per share. Line 5 is net income. Lines 43 and 44 are EBITDA. So what I like to do, we have data back to 2004. So to get short-term growth rate, I like to start with how have they been growing. I was talking about this in my previous class. Beta is not a forecast. I mean, it's not a historical number. You can use history, but you have to do that 4-step process, and history is only one of those things. Same thing with growth. So beta, you would never just use regression beta. You want to make sure you're forecasting. Same thing with growth. You wouldn't just use historical growth. But with historical growth, I don't know who that is. Did they go off? Was that you? Or whoever? Yeah, make sure you're on pause. All right. So with historical growth, I like to see just how have they been growing. Now, I generally like to do 3-year, 5-year, and 10-year. But what's going to be your problem with 3-year? It's going to be COVID, right? And the shutdown. So that's going to be an issue, but we'll see. So what's the formula for 3-year growth? Anybody remember? So ending over beginning raised to the 1 divided by 3 minus 1. Y'all remember that formula? But the beginning is not 3 years ago, the beginning is 4 years ago. All right, it's 3 growth periods. So our ending value is going to be net income and well, I have to do 2020 net income in 2020 divided not by 2022, not divided not by 2020, but by 2019. All right. That might actually be good to do pre-COVID versus post. I'm just not sure Walmart is pre or post-COVID because I don't know where their 2018 and 19 starts and ends. All right. So you have to have 4 different years in there because it's not number of years, it's number of growth periods. So you grow from E to D, that's 1, D to C, that's 2, C to B, that's 3. And you're going to raise that 1 divided by 3 minus 1. What do y'all think for Walmart? Have they grown since pre-COVID or shrunk? You know, 2020 they grew, right? Everybody stopped going to restaurants and suddenly went to Walmart. But they've had struggle here recently. So I don't really know, but let's see. I hit enter. It's actually down 7%. So their income was 11 billion and it was 14 billion. So -7. 5 years, we do ending value divided by 1, 2, 3, 4, 5, 6. Raise 1 divided by 5 minus 1. So what are we seeing with Walmart? What can you guess is my issue with Walmart? That 2019 is not 2019, is it? So it's probably, I forget when their fiscal year is, if it's February or March. So it's probably something like April, May 2019 through March 2020 or something. It probably includes some 2020. So it probably includes that massive buildup in 2020. So I really think this 3 years is not pre-COVID, it's actually post-COVID. And that makes sense. Because if you look at it, I mean, you can see COVID, can't you? That's not 2019, that's 2020. All right. So make sure that be careful. It depends on your company. You know, for some of you, like if a Valero, you can see 2020 because the numbers are falling dramatically. But with Walmart, this is definitely an issue of we're going off the COVID boom year. So 5 years only 344. That's not that great of a growth rate. And then we do 10-year. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Whoa. And that's going to be a negative number. So there's the Amazon effect. Now, the other issue here is the last year is somewhat low. So that's probably the inflationary impact. Prices going up, margins being hampered somewhat. So I might do this instead of doing off of the last year, I might do it off the previous year. So I might move all this back. How would I move it all back? Pretty easy. I'll just move it back. And do that. So if you have a year that's unusual, do it a different growth period if it's just something bizarre going on. All right. So COVID is messing this up for Walmart. It may be messing it up for yours as well. Jose and Juan Carlos, who knows what mortgage rates are doing to your company? You know, so if your last year is not correct, then you might have an issue. The other thing you can do is a rolling 3-year. So you just show the growth rate. There's the COVID. You see the growth rate over time. It's just Walmart, because of the Amazon effect, they're not showing much growth. They have not grown all that fast last several years. So set up the 3 years. And then you can just copy it back and you get a rolling 3 years as well and see if there's any story there. Same thing on the 5 years. Rolling 5 years. Then rolling 10 years. It's not much growth at all. Now that's net income. We can do the same thing with earnings per share. Earnings per share looks a lot stronger. It's normalized earnings per share, so that may help you some. There's earnings per share. You can do the same thing with EBITDA and EBIT. So I started with net income. Net income is not giving you as good a number as EBITDA and EBIT. You can also do the same thing. I should have said, you can also do the same thing on revenue. Whether you can use these numbers or not depends on what numbers you get. So you're trying to find something that give you a pretty good story. Are you seeing any evidence here that Walmart can grow 7-8%? They certainly haven't. Even when you use earnings per share, which is distorted by the stock buybacks, even then you're not, you see the COVID effect, yeah, definitely. But when you go back longer history, this is not a firm that's just a massive growth firm. It was a firm that was struggling. I think it's pretty impressive what they've done recently. And they have with curbside and the order online, they're doing some impressive things, but this is not a 7-8%. We're talking, short term. All right. So history is part of it. Everybody following what I'm doing here, you got this in that file for paper 3. You have a lot of history. You can do rolling 3 and 5 and 10 years. You can change your period of time. So there's the formula, whatever period of time you want to use. Now for floor and design, my guess is you're going to get some massive numbers because as a small company has become big. So, so you're really trying to see, are they kind of leveling off? And it's probably pretty volatile as well. I don't know, was 2020 a big year for them? Were people just remodeling their houses? Yeah, I mean, why not? Although you're at home all day and they're messing up your house, it's really irritating to remodel houses, and it's noisy and it's dusty. They had my refrigerator chain closed, and I had to go to Subway to eat you can't get into your refrigerator for the next 3 days. Oh, that's good enough. But people are bored. They wanted something to do, so they remodel their house. Well, is that going to happen again? Do you take that out of your numbers? What are you trying to get a sense on this business? If you got a competitor that's very similar, you might do the same thing. Look at their competitor. It's pretty easy to bring these numbers in. Look at a competitor and see what kind of growth rates they have. Those are kind of things you can do. So when you're looking at short-term growth, so look at historical 3, 5, and 10. I like earnings per share because ultimately earnings per share is what we're after. I could have let's just see. I don't think this is going to work. We'll try it. Let's go look for dividends per share. I don't remember where I put it. It's in here somewhere, but I don't see it. 40? Oh, there it is. Yeah, they're so consistent on dividend policy. It's just like 2%, 2%, 2%. They increase it a penny every quarter, so it's almost a declining. It's declining because they just go up exactly 1 penny. And obviously 1 penny becomes a smaller percent. So this is part of the problem with the dividends. The dividend discount model is dividends are somewhat a manufactured number. It's not a true growth number. So I think ultimately earnings per share growth is probably your best bet. for our growth numbers. So that's part of the most reliable. But EBITDA and EBIT can be interesting as well. So historical is just giving you a sense. And then you have your paper 4. What were you saying in paper 4? So you could, if you wanted to, can just use paper 4 as short-term growth. If you feel comfortable with that number, what is the earnings per share in your forecast in paper 4? So go look at that. You look at Walmart. I don't know if I put the forecast in here. Let's see. This may not be the one. Yeah, this was the one I was working on. So their EBIT growth rate. %7. Boy, I was pretty aggressive on that forecast, wasn't I? So you can just get the growth rate out of your forecast. Because you already did that work, right? Now, what would be wrong? What would be wrong is if your forecast in paper 4 is 7% and your short-term growth in paper 6 is like 12% or something. All right. So it needs to be in the ballpark. How are you going to do it? It needs to be in the ballpark, right? The other thing I can look at here is year to year. This can be a little frightening. And I'm not sure if this is a good forecast now. I can't remember how hard I worked on this. So I have a huge growth in the first year. That may make sense because their income fell so much this last year. Maybe I'm just making up for that or something. And something else that can also be pretty interesting is to do your forecast growth compared to the historical growth. You can get some pretty radical numbers. But just to see, maybe better would be to do this on a 3-year basis. Then want to hit escape. Well, I guess it doesn't matter. I'm already escaped. You still get some pretty radical numbers with Walmart, so it's just all over the place. But what you're trying to do is get reasonableness. Is my forecast reasonable? Reasonableness, I hate to say it, reasonableness is almost always compared to history. A firm is generally growing 3 to 4%. Why are you suddenly thinking I can grow 6, 7%? So anything you can do, kind of set it up that, hey, this is reasonable given what they're going to do. If it's not reasonable, if a shift from history, you need a story. What's different? What's going on? What are they doing differently? So with Walmart, wow, you know what? Walmart really is doing great on the internet. They're somewhat taking some of Amazon's shine away. Amazon's struggling with some personnel issues and profitability issues. Amazon's gonna have to raise rates, especially on Amazon Prime. They're just losing all these kind of things. Yeah, I think Walmart is going to start, just as long as you have a story, you can justify it, but you can't go from 3% to 7% growth without that story to explain why. It can't just be, that's what happened. That's just how my forecast came out. Like you have no control over it. So you need to have some story there. Question on those first two. So don't forget paper 4. I get so many papers where they rate paper 6 as if they never wrote paper 4. And it's like, what? It's like, did someone else come in and start writing this paper for you? And then you have the easy ones. Anybody remember the easy ones from paper 4 from investment class? All the people in those classes are avoiding eye contact. Do you remember? Were you in my investment class too, or two? Yeah, you remember? Paper 4, short-term growth. Do you remember Peggy? What's the PEG ratio? You may remember that one? It's the PE, it's the forward PE divided by 5-year expected growth. I don't know how to spell forward. I still don't know how to spell forward. So the PEG ratio is the forward PE, it's the forward PE ratio. So it's their PE ratio with next year's earnings divided by expected 5-year growth. So that means expected growth equals forward PE divided by PEG ratio. Now, what is this? This is someone else's short-term growth. So why are you doing that? You're doing that kind of your emphasis of what does the market think? I'm assuming 7%, but the market's thinking 3%. Or I'm assuming 5%, and the market's got 8.5%. All right. So let's do that real quickly for Walmart. Now, one thing to be careful here is, well, it's kind of, you have a little bit of advantage with the forward PE because we know that Walmart's current earnings are somewhat subdued. So the forward PE does protect you some on that. If you have an unusual year, usually the forward PE is a little bit more normal. So you go to statistics, and their forward PE is, yeah, sometimes this current column gives you some really, really wild numbers. So I'm going to go with this column. You know, you can do them both. The current sometimes, I just think it's, I don't know what, they're doing something strange there. So 2577. Their PEG ratio, here it is right here. They tell you 5-year expected. So that just means the growth rate over the next 5 years. Now, I'm not sure if that means that's the average growth rate over the next 5 years. If that's the growth rate next year declining, you know, who knows? But I'm just going to assume it's the average over the next 5 years, right? So their PEG ratio was 357. So you take 25.77 divided by 3.57, and you get 7.23. Now that's 7.23%. Did I do it right? 7.22, sorry. 7.22%. That seems real close to my forecast. So that doesn't seem, you know, obviously I like that because it's close to my numbers. So obviously I'm good about it. So that is one approach. How do you put that into your paper? Well, this is why a couple of things. I could say, therefore, my 7% forecast is reasonable versus analyst. Or if it's radically different, then you got a little more work. Therefore, my 4.3% forecast is quite conservative, but I think the market is getting something wrong. Your boss likes the second one a lot better because that's when they get excited. The problem is you don't know what the market thinks. You're just making stuff up. So what do you think is the biggest difference in what you think and what the market thinks. So that's where the PEG ratio can come in and give you some insights on. Now, do you just back into the PEG ratio number? I wouldn't do that. You should have your number first, have some conviction. Questions on the PEG ratio? That was a really simple one. It gives you a real quick number to see if you're in the ballpark at all. You could use the EE function in Bloomberg. Very similar. It's more direct. So Bloomberg on the EE function, they'll give you a forecast for earnings per share for your company. And you can pull your growth rates right out of that. And they'll give you EBIT and EBITDA. So the EE function, or you can do both, because these are analysts, but they may not be the same analysts. Who knows who these people are? There's different sources. A firm like Walmart, one thing you have to be careful of is watch the number forecast. What sometimes happens is there's like 6 forecasts for the next 2 years, 3 for the next 3 years, and there's just one guy out there for 5 years. So you just got one person, and you don't know. They're probably doing more work than you are, but you don't really know who that person is and how trustworthy they are. All right. All right, what's another approach we did in investment class? Has it been that long? So do you remember sustainable growth? Anybody remember that one? What's that formula? Now you might say sustainable growth, that sounds like a long-term number, but it's not, because you're using current numbers. So it really is a shorter term number. So ROE times 1 minus payout. One thing to be careful here is it normalized ROE times 1 minus normalized payout. So that's important, okay? If their ROE is usually 12, 13%, and last year was 43%, use the normalized number, okay? So don't just use the latest number. So let's look at Walmart. So you can use normalize. You can use a paper 3 file to normalize. So return on equity. I saw it just a minute ago. Here it is. Return on equity. It's line 45. And payout is, I don't know why that's red, but payout is dividend per share divided by earnings per share. Oh, I shouldn't have highlighted that. Where was earnings per share? I can't remember. Stop me if you see it. I'm still not seeing it. Earnings per share. There it is. So there's their payout. So just looking at return on equity, the last few years, it's averaged 16%. And then it really falls off. So do you do the average? You do the median? Is it exaggerated because of COVID? Do you just use the last 3 years, which is averaging 15%? So you find a number, let's say 15%, all right? And then the payout is average 46%. It's been jumping around, but 46%. So let's try that. And so 15% and 46%. $15 times 54. And that gives us 8.1%. This is not a horrible number as long as you normalize. If you don't normalize, it's probably a bogus number, but if you normalize. Now, do you use the average or the median? If you have 1 year that's like 87%, or you have one that's negative 50%, you have some crazy year, then yeah, use the median, don't use the average. So with Walmart, the average looked like was a pretty decent number. Right. Not a bad number if you normalize, otherwise it's probably a bogus number. Questions on that one? Correct. What else is there? The last thing is just discussion. You just give the story. But I really think that's paper 4. So don't repeat paper 4 and paper 6. It's just no reason to. You've already done it once. You can quite a bit in this paper say, as I discussed previously on growth, blah, 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 and bring it forward. So it gives you some basis for your number. Now, maybe you should have done this before you did paper 4, but hopefully you can get some consistency between the two. All right. Oops. Y'all want me to save this to Blackboard? Y'all never say no to that question. It's like, why not? If I don't use it, at least it's out there. Yeah, there's no reason to say no. So you are somewhat going back to previous papers. So paper 1 is about how fast the industry is growing. Paper 3 through 5 is really 2 through 5, 2 through 4. This should say 2 through 4. We changed the paper number, sorry. One thing you might do in this paper that could be really, really interesting is rather than using actual growth rates, is instead go back to the asset turnover times margin chart, because that means ultimately what growth is. Are they improving on that? Or are they getting worse? So if a firm's growing, they're either growing their revenue, which is turnover, or are they getting more efficient, which is margin. And I look at their asset turnover times, wherever it is, asset turnover times margin, and it's just been dwindling down. So there's not a trend back up at all. You get a little bit of a COVID kick in there. So you could do a graph of your historical asset turnover times net margin with your forecast from paper 4, just to see, are you expecting something unusual with your company growth wise? Because real growth is either better turnover or better margins. You're not going to increase your growth by just borrowing a lot of extra money.
So, yes, but did you use the industry that is the passenger airline?
Oh, I need to take those out.
So I don't know if that is chart.
Well, it's not a disaster to have them in there. There's just is a very different industry, but
FedEx,
you can, yeah.
oh,
Well, it's they're similar businesses. They're transporting people instead of stuff. But you know, they got fuel, they got big planes, and there are a lot of airlines that do some shipping as well. So I mean, I don't think it's disaster. They're, you know, Russell puts them in that category. I would put them in under travel and leisure, but Russell puts them in there in transportation for some reason. So yeah. I mean, putting them in transportation would be like Carnival Cruise, putting them in transportation. It just doesn't make sense to me. But I don't think it's a disaster to do that.
I leave it like that because I didn't want to do any changes, but I'm afraid of.
Well, if you're using UPS, so some of the stuff we're doing for growth here, you might do some of this, but do it for both UPS and FedEx. And see, would you get a radically different number for FDX than you do for UPS? And that might tell you that why is that? Why do I see these two firms so different? So, and because it's pretty fast. You saw what I do with Walmart, right? It doesn't take that much time to do it. If you did the PEG ratio, it says why do they think FedEx? You know, we could try real quick, right? And just see why do they think FedEx is going to be so much different? So FedEx's forward PE is 1484. And their PEG is 112. That's a high growth rate, isn't it? 13%. And then your UPS, 4P 1664. PEG 253, so much lower growth. So why is that? Why do they think FedEx is going to grow so much faster than UPS? And I can't remember what you're doing, UPS or FedEx. Yeah, so why do they think that? Is it because something unusual has happened to FedEx or something unusual happened to UPS or something, you know? That's a pretty radically different number for those two entities. So their PE is higher, but their PEG ratio is much higher, which means you're dividing by a much lower growth rate. So, you know, it's kind of strange that they don't think that growth is going to be there. So then the question is going to be, was this last year unusual for one of the two of them that would cause that to happen? Yeah, so if you have, you know, UPS is kind of easy because it's FedEx and UPS, so that's kind of nice. If you're doing, you know, floor and design, could you do Home Depot and Lowe's? Maybe, but remember, you can't do the ROE for them because they don't have any net equity. But you could do some of these other things. So the PEG ratio to me is a simple one. If you have three companies and say, wow, I would imagine for floor and design that their PEGs can be much higher growth rate than Home Depot and Lowe's just because they're smaller. But I'm not knowing that for sure. But it's so fast, it's so easy to do this. In fact, you probably could do it in Capital IQ. Capital IQ probably has PEG ratios and probably has forward PE ratios. So you might be able to do that just in the software itself. So that gives you some, you know, some insights on the market. So ATO on margin, that chart, if you do that chart in paper 4, I really like that. Is your historical ATO on margin different than what your forecast is showing? Because that means you're expecting growth to be very different than in the past. So I think that's a pretty critical chart. I can't remember if I put that chart in there. If not, you'd probably want to add it. There, I do have it. ATO times margin. It's been declining. It's come back with 2020. I have it just essentially 2017, 2018 were just the height of Amazon taking over business and then back to kind of normal. So I expect growth to be real similar to here in the recent past. So I think this is a good chart. If this chart is unusual in some way, it means that you're expecting something quite radical. Is it radical because you're expecting better ATO or expecting better margins? Which of those two is really driving that? But I think it's an important chart from a growth standpoint. And then, do you expect your firm to grow much faster than the rest of the industry? Do they have something that's giving them extra market share? What are they doing? Are they expanding overseas? Do they have some advantage somewhere? Last few business breakdowns that I listened to was just so exceptional. Business breakdowns do give you some sense of expected growth going forward. So you might go back and listen to that podcast again. That's pretty interesting. All right, so don't forget paper one. If paper one, like for floor and design, you're talking about the US housing market, mortgage rates, whatever you're doing, that's going to come back into your growth rate here on the short term. So you might have a short-term growth rate that looks below average because mortgage rates are so high, but then it's going to come back to normal, whatever. So have some consistency. That's the hardest part about this class is you want all nine of the papers to be integrated and reflected, but you're writing one paper at a time. And it's really hard to do that because you're kind of changing gears into a new paper. All right. So we talked about the PEG ratio approach, the historical sustainable growth. I love emails I got, especially in the investment class, is, Professor, where do I get my short-term growth? It's like, where do you get anything? That's the future. It doesn't exist. You can't go, oh, look it up here. Yeah, Walmart's next 10-year growth rate, you can find it at this website. They'll tell you. We don't know that number. Nobody's right. Everybody's making a guess. So the key is not to get the right answer. The key is to get an answer that's reasonable, well justified, something that you can, sorry, anytime I say paper 5, I mean paper 4. I used to have the economic macro as a separate paper, but so that's why I keep changing my paper numbers. All right. So we only need one more thing then, and that's the timing. How long does the short-term growth rate last for you to get to the long term? Is that 2 years? Is it 10 years? Is it 20 years? So if I were doing Valero, I might say, okay, you could probably find out there forecast of EV market share. You would probably be able to find some pretty good articles that say that. Are EVs going to be 100% of the market at any time soon? Who knows? But there's people doing those kind of forecasts, so they're out there. You can do them. The best firm out there. Oh my word! Oh, what's the name of the firm? I can't remember it. Alliance Bernstein. They're the ones that are in I-10. The Alliance Bernstein. They wrote some of the best industry analyses, but they're not free. They're pretty expensive. We had to do some soft dollar to get their analysis. It's several $100,000, so you may not want to go out and purchase it yourself. But they had some really good this is what we see over the next 10 years with wonderful, wonderful data. But you see some of these investment banks do put that stuff out there for free. So I probably should have told you about this for paper 1 and paper 4. But the driving force for your industry's growth is the sales of EVs. You can find those kind of forecasts out there. They do exist. If for, I don't know, for Jay, for your firm, maybe it's online sales, you can probably find a forecast of online sales, a percentage of total sales or whatever. Or, there's forecasts out there that show you that kind of thing. So that's going to help you with the timing because those type of reports will say over the next 10 years or next 20 years, we're going to have this kind of thing. And so the timing is probably the thing where students struggle the most. It's probably where they lose the most points. So let me tell you what doesn't work. So we're going to use the H. So H equals number of years divided by 2. So if you think it's going to take 10 years, your H is 5. So this is what I get students doing. I think it will take 10 years. So my H is 5. So I say you need to justify that H. Well, that's not justifying the H, because what's wrong with that discussion? I don't know where the 10 years came from. Well, for a lot of students, that's their entire discussion. I think it's going to take 10 years, so I'm going to use an H of 5. That's not good. All right. So right is what? Creative writing. You've got to come up with something that seems reasonable, because nobody knows. Or find some basis. So yeah, if I were you doing Valero, I would try to find some basis. They're doing these getting oil, these cooking oils from all these restaurants that they're going to make, that's a biofuel. They're going to use that to help create energy to go to electric companies to power cars. How is that going to grow? How important is that going to get? We're going to expect them to be declining because of the growth in EVs. Some basis. And again, if you give me a reasonable basis that seems logical, you know your industry better than I will, because I don't know a lot of these industries all that well. I'm gonna buy it. I'm gonna go for it. Same thing with your boss. Your boss might be a utilities analyst, and she wants to know what you think about the pharmaceuticals industry. They're gonna buy whatever you say because you're the expert in that. So you make it reasonable. What they're not gonna buy is there's not a logic to what you're saying. It doesn't make sense. Yeah, I think 120% of cars are going to be EVs in 10 years. That doesn't make a lot of sense. You can only have 100%. So it needs to be reasonable. One thing to remember, though, is something I used to show a chart with this. I should update this chart. I should do this. But 10 years is a long time for high growth. So you go back to the firms that were just the power plays, the Intels, the Amazons, Microsofts, those firms that just had massive, massive growth. You might think, wow, they grew really fast for 20, 30 years. No, they didn't. Their really high growth period was about a decade. That's about as long as they go. And that's what those are the ones that went from a few $100 million firms to $1 trillion firms, Apple. Even those firms, they could not sustain a high growth for more than 10 years. It was 10 years of this massive growth and then kind of 6-7% kind of growth rates. So if you're using more than 10 years, you're getting, for 20% kind of growth, that's getting a little bit out of the ballpark. Now, many of your companies are huge, right? UPS, trucking, these firms have been around for years. They're probably not going to grow 8, 9, 10% for 20 years. They just can't do it. So some of you are going to maybe have 6-7% growth for 2 or 3 years. You're just and that may be what I do for Walmart. They had a really bad year. I think you're gonna get back to normal over the next 3 years. They're curbside. I think they've got some wings there. There's an awful lot of Walmart stores there. People are starting to get used to order from Walmart online and pick it up when I'm going on the way to work. Those kind of things. I can kind of make that a good story to say, yeah, I think they're gonna have some good 7% growth the next 5 or so years, and then back to the 5% growth. All right. I don't like this one. We'll talk about, well, I'm sorry. I thought this was, I'm sorry. I misread my notes. So we'll talk about your dividend in this. So, what if your firm doesn't pay dividends? I'll give you a substitute for that. I'll show you how to do that in Cap IQ. I'll do it in the next class. You do need earnings per share and inflation. So we'll talk about some of these. So a lot of this can be pretty straightforward stuff, but the bulk of your paper is especially getting that short-term growth. Your long-term growth, you essentially did that back in paper 5, so you're probably ready to go. All right, so next class, we'll talk the valuation models that you want to use, and we'll do some examples on that. All right, questions on any of that? How's papers 2 and 3 going? So if you want to turn 2 and 3 in and leave 4 to do 4, 5, and 6, that's fine. Some of y'all, I really think you need to sit down with me on paper 4 and we just kind of figure it out together because it's gonna be really tough, right? Alice and I were talking about that. It's gonna be a little tough. You have to have some basis, but we can certainly do that. All right, questions on anything? So the class is starting to get a little easier now. You've gotten through the hardest part. The question now is fatigue, right? You're getting tired and it's a tough class. But think at the end, you're gonna have a paper that's gonna get you jobs. So, just kind of diligently stick with it. So what do y'all think about not having a class, but doing breakout sessions where I find times Monday and Tuesday to go down to FSC in groups of like 6 or 7 with similar industries? Would that work? That makes sense. We just get paper 7 out of the way, the bulk of it, and you have your file, because paper 7 is about 70% Excel work and 30% writing. So we'll figure that out. You're probably not in the mood to do it yet because we're not close enough to it.
If we do record, do that in during class time, we do that means like.
Do what?
If we do that, it's records, like during class time.
It had to be more than class time because I would only give 1 walk. So we have to find your schedules and see how that would work. But I probably need 45 minutes per session. Part of the issue is, well, you have to have Bloomberg, and there's only 12 Bloomberg machines in there. So it would take at least 2 sessions. So we have to figure it out. It may be possible if I can do it in 45 minutes. So maybe one group goes from 7:20 and the other group goes from afterwards or whatever. We'll see, because y'all don't have a class afterwards, right? And so, just bring caffeine. We'll figure it out and see how it goes. It's possible I can do one in 40 minutes. We can see. But we'll see. So we can probably get half the class in the FSC and get it to work. I'll have to count the machines in there. I think there's 12 in there. So, all right, we'll work on that. We won't do it next week, so we got some time before. All right, we'll stop there.